And my CFP designation is a course of study, a 2-year course of study beyond college, which where I've developed an expertise in all aspects of family finance, everything from retirement planning to mortgage and debt analysis to investment planning, and especially college. So everything ties into the tax return, which is an area that I also have a high degree of specialty in too. I don't prepare taxes, but I review tax returns often as a extra pair of eyes as to see what the accountant is doing. So as Scott had mentioned, today is October 1st. For senior parents, October 1st is the beginning date to start working on filling out the FAFSA. The FAFSA is the free application for federal student aid. It is a free application. It is issued by the federal government, and its intention is to fairly distribute federal financial aid. The colleges, though, every college asks for it. The colleges use the information that you provide in the FAFSA to not only distribute the federal financial aid that the government makes available, but they also use the FAFSA to dig deep into their pockets for the right student to help make college affordable. So let's look at the timeline. And again, we're talking about seniors. Obviously, junior parents, sophomore parents, and freshman parents, you'll be here soon enough. And the same time frame will work for you. And again, you might be able to tune in and see me again when your son or daughter reaches this point. So in October, we begin the college search, begin applications, start working on the FAFSA, and of course, the CSS profile, which we'll talk about a little later. So the college application process, there's 3 ways to apply for college. You can apply early action, early decision, or regular. I'm going to try to draw a line of distinction between early action and early decision. I will say that I've run into a lot of folks who, a lot of students too, who decided that they want to apply early decision because they've been told that it will improve their chances of getting into the college of their choice, as opposed to early action. Well, both applications can start now. And the idea is that you want to submit the application now with the expectation that you're going to receive an answer from the college before the end of the first half of your senior year. Hopefully, all will be acceptances. Let's talk about early action for starters. You can apply to as many colleges as you wish, early action. Notice the last line on the bottom of the page, I'm moving my cursor over it. Decision day is May 1st. That's an important date because if a student were to apply to 10 or 15 colleges early action, and if sometime before December 31st they receive acceptance letters from those 10 or 15 colleges, that student can sit and wait for the next 5 months until May 1st to decide which school he or she will decide which school they'll be attending. So they've received the acceptance letters. The college is holding a seat available for that student. And now the college has got to sweat it out. Now, in all likelihood, the student knows which colleges they prefer. They can apply to schools that are safety schools, reach schools, which are those that are slightly above their head, and target schools, right where they fit in the meat of the order. And the idea would be that every student would most likely prefer to go to a reach school. It's kind of a pride thing, though it will be difficult to keep up with excellent students because these are all students who have performed a little better than you academically, GPA-wise, SAT-wise, and so on and so forth. So if you apply early action, again, you can receive all the acceptances and you can drag the college out for the next 5 months. And the reason I wanted to reemphasize that is a lot of students and a lot of parents feel that it's their students, their sons and daughters who are in competition with the other peer students to get into these colleges. When in actuality, it's the colleges that are competing for our kids, especially those kids that have high academic achievements. Let me stop for a minute and let me mention early decision as opposed to early action. Early decision is a one-way contract. If you apply early decision to a college and they accept you, you are bound by that contract to attend that school. And you are supposed to withdraw all other college applications. Now think about this for a moment. If May 1st is the deadline and the colleges are sweating out the early action students to see who will say, fine, I will be attending, as opposed to early decision, as soon as that college accepts a student early decision, they know that student will be attending. They no longer have to worry about holding that seat. It's filled. On the same note, these colleges know that they're, as I said, in competition for our students. So they want to see the FAFSA, the free application for federal student aid. Why? Because they want to know if these families can afford to send their son and daughter to their school. As they sweat it out and wait. Early decision, there's no argument. You applied, you're coming, whether you can afford it or not. So the argument of getting into a school of your choice early decision is improved by filing an application early decision. It, in all likelihood, is going to reduce the amount of financial aid that the college needs to award you because there's no incentive to get you to come. You're going. By February, I'm sorry.
Wait, Mr. Trace.
Yeah.
We do have a question.
Sure.
So what I'll try to do is wait before when you change slides. That's when I'll jump in.
Excellent.
We had a question that said, what implications does divorce have on FAFSA and which parent applies?
Okay. So in a divorce type of situation, I'm going to get into this a little deeper as we move forward. But the FAFSA, the free application for federal student aid, is a very generous, it's a very forgiving application. The reason I say it's very forgiving is because they only look at what is referred to as the custodial parent. The custodial parent is the parent whose household that student lives in most of the year. And it can even be only one day more than with the estranged parent. So if mom and dad are divorced or even separated, they don't have to be divorced. And dad is moved out and the kids are living with mom. Mom's household is the custodial household, and it is that financial information that needs to be provided. Dad's information does not come into play. I'll get into that a little bit more as we move on.
Okay, and then we just had another question. As a custodial parent but remarried, and is my salary looked at or combined with the new husband?
Yes. So think about this for a moment. The custodial household is everyone who lives under that roof. Mom and dad are divorced. Dad has moved out. The children are living with mom. For argument's sake, two kids living in the household. Mom then gets remarried and the new spouse moves in. It's now a family of four. It's in all likelihood a two-income family. If not a two-income family, you figure that the new husband is earning an income and there's in all likelihood some child support coming in from the estranged parent. So even though the new spouse, the new husband does not or is not responsible for paying for his stepchildren, it is still his income that is included on the FAFSA that determines financial aid. I'm going to move on. So what is financial aid? Financial aid is anything and everything that helps you pay for college. And I like to include one more component, and that would be the way you prepare your income taxes. So financial aid is money from the government, which is hard to come by, let's say. It is money from the state if your son or daughter decides to attend a college in the state of New Jersey. It is aid from the college where your son or daughter will be attending, and that typically comes in the form of an incentive. Remember what I said before. If you apply early action, these colleges know they're in competition. And in order to make a college more affordable to a very well-accomplished student, they're going to throw money on the table, especially for high GPA or high SAT score. That money comes in the form of merit aid. And the idea would be to incentivize. If you want to figure for a moment, a school like TCNJ or Rutgers, which could cost anywhere from $26,000, $27,000 a year all in, versus, let's say, a Seton Hall or Rider University, which might cost somewhere in the neighborhood of $50,000, $55,000, $60,000 a year. The school's going to look at the FAFSA and they're going to say, well, in all likelihood, they're applying to some of these less expensive schools. So we have to bring the $55,000 price down for these bright kids to entice them, to give them an incentive to consider coming here. Financial aid also comes in the form of scholarships from other sources. Obviously, Wayne has a scholarship night where kids apply for local scholarships from Rotary clubs and different groups in town. And those outside scholarships can be a valuable source. Financial aid also comes in the form of loans. That's something that I don't like to see people have to take, but sometimes loans are necessary. And of course, the other component I would say would be the way you prepare your income taxes. And small business owners would have a lot of leeway as far as that's concerned.
All right, we have two quick questions.
Sure.
The first one is, what if the mom does not file taxes other than alimony?
Okay, so when you fill out the FAFSA, FAFSA is going to ask you a number of questions, one of which is, did you file an income tax return? For senior parents, the year is 2019. So they're going to ask if you have filed a 2019 tax return. There'll be a drop down. That drop down will say already completed, will file, or not required to file. You'll choose one of the three. Now, since they're using the 2019 tax return, it's very rare that you're going to select the answer will file, because the deadline for filing is long past. So it's probably going to be already completed or not required to file. If mom is the custodial parent, separated and divorced, and she clicks the not required to file, they will still ask questions about income coming into the home, which will include alimony and child support. So those things do come into play. But there is also something that you will not be able to do, and that's connecting directly to the IRS computers. And I'll talk about that a little later on.
All right, we have one more question.
Go right ahead.
If there was equal parenting time, who should file?
Okay, now that is a toss-up, and that's where you have a certain degree of leeway. You're supposed to be as accurate as possible. You're supposed to report the custodial parent as, even if it's a few hours more. But in all likelihood, consider for a moment, it would be wise to select the parent. If it's almost equal, it would be wise to select the parent with the lower income, because that would improve the chances of more financial aid. Now, it also would help if the students are attending a school in Wayne, New Jersey, and let's say mom lives in Wayne, dad lives in Atlantic City. It's going to be difficult to justify the custodial parent as dad who lives down in Atlantic City. You understand the proximity, the geographical location. What I do recommend, though, even if it's a neighboring town, list both parents' addresses with the school to let them know that this is a situation where there are two parents living in two separate locations, and the student can go to either house, as there is a shared custody.
All right, and then we had another one come up. So a divorced family, they alternate filing, claiming the child on tax returns on the
Understood.
2020 tax returns.
Right.
Even though the one parent is the custodial parent, does she mark off that he filed that year? Not
a concern. The reason is that you understand that obviously a divorce is something that is handled by a court, and the court is going to rule based on the parents' agreement who's going to deduct or take the deduction for that minor in any particular year. A lot of times it's alternating years. In some cases where there's two kids, it may be the oldest child dad will take until the oldest child is out of high school, and then dad will switch and take the younger child. It doesn't matter. If dad has a higher income, kids are living with mom, dad can benefit more from the deduction. Both agree, and the court rules that dad takes a deduction. Mom can still be the custodial parent, regardless of the fact that the child does not appear as a dependent on mom's tax return. One thing I will mention though, there are a number of higher education tax credits that come into play. Those higher education tax credits can be pretty lucrative. The American Opportunity Tax Credit is $2,500 a year, cash in your pocket, coming back to you, even if you haven't paid taxes. But there is a phase out number. So suppose that dad is taking the deduction because that's what both agreed on, but dad has a high income above the phase out limit. So he would not even qualify to get the higher education American tax credit of $2,500, yet he's taken the deduction. The child's name does not appear on mom's. Mom cannot file for that American Opportunity Tax Credit unless mom takes a deduction in that year. And that's where I will argue is a case in point where financial aid comes into play in the form of how you prepare your taxes. So something like that, I think it's important. And if you notice at the bottom of the screen is my email, also my cell phone number. If you have a particular situation after this presentation and you'd like to send me a text, send me an email with a question, because maybe it's too personal for it to be read out loud, I'd be happy to take your question, answer it, and look at your situation in particular. And there's no cost, there's no obligation.
All right, we had two more come in.
Okay.
What if one parent just passed away, but his income is on the 2019 tax return, but this has changed for 2020?
Absolutely. Well, a number of things can change, especially given the fact that financial aid is distributed based on what is referred to as prior. I call it prior, or that's what it was deemed when they changed the rule and decided that a student, in this case, who will be attending college in September of 2021, is using not the prior year financial information, but the prior, 2019. So you're filling out the FAFSA for your son or daughter to attend school in September of 2021, and you're using your tax return from 2019. Things have changed since 2019. Just think of COVID. Think how people have maybe lost their jobs, have been furloughed, have been laid off. The business is closed. What existed in 2019 doesn't exist now, and it certainly won't apply for September 2021. A parent has passed away, a parent has fallen ill and maybe can't return to work. Insurance doesn't cover all the medical bills, so the cost of medical care is through the roof, adding an extra burden. Well, what I'll say to you is that the most important thing is for your son or daughter to get accepted at these colleges. And then once they're accepted, the line of communication with the financial aid office is wide open. You have the opportunity to appeal the financial aid award. You have the opportunity to file a form which is called Change in Family Financial Circumstances. And there are many. And with COVID-19, I would say even that many more. So yes, things do change. Yes, you do have to communicate with the financial aid office, but don't be too quick to get a hold of the colleges until your son or daughter has been accepted by the school. That's when they're going to want to talk to you, not before.
And then we have one more that probably carries over with what you were just saying. What happens if 2019 tax return is higher than prior years, but will not be as high in 2020?
Well, from many colleges' points of view, that's too bad. That's the stance they'll probably take. They'll probably look at it from the standpoint. Now, remember what I say before. the grace that they will give you is based on the academic achievements of the student. You want to consider for a moment that every school publishes what their average GPA for their incoming freshman class was last year, the year before, and so on and so forth. And you can find that on collegeboard.org. On collegeboard.org, you can type in the name of the college in the search bar, and it will pull up the information as far as what the GPA, what the SAT was for incoming freshman class. It will also talk about how much financial aid as a percentage of cost to attend they typically award. But if a school is advertising that they have an average incoming GPA of 3.0 and your son or daughter's a 3.4, 3.5, and you had an aberration year in 2019, exceptional year, the college has accepted your son or daughter. Now your income has fallen off the charts. Well, they would be more apt to listen to that change in family circumstance and not give you the pat answer, well, we'll worry about it next year. You understand that the student with the high academic achievement commands the greatest amount of attention. And that's why it's important to, in my opinion, well, again, I think SATs are kind of out the window this year, aren't they?
We're working on that.
Okay.
We're hoping to, I know Wayne Hills is offering the SATs in November, and we have a date in December 5th, we'll be hosting the SATs.
Right, but then again, many of the colleges aren't even looking at the SAT score at this
point.
Yes,
and I'm sure Mr. Paul can speak to that, but a lot of the schools that we're getting back, there's a lot of them are saying test optional.
Good.
Yeah, we have virtual college visits. Students are encouraged to sit in on Zoom meetings that we have about, I'd say around 50 schools that we've set meetings up with. And the consensus that we're getting back from a significant amount of them is they're all going test optional, given what's going on right now.
Good. So that takes one extra component out of the equation. Again, a student starts college, starts high school, freshman, sophomore, becomes serious about his or her studies. Junior, senior year, does extremely well junior, senior year, but then again, they're looking at all 4 years combined. Something that would have carried the ball over the end zone in the past has been high SAT scores, and that's where maybe taking the SAT several times to improve your score was good logic. 2019 being an aberration year, you made more money in 2019. It's still, once the student is accepted, worth approaching the financial aid office and explaining your situation. In all likelihood, they're going to direct you to that form on their website, Change in Family Financial Circumstances form, where you can explain what's going on. So there's always that option, again, after the student has been accepted. So, moving on, I've already mentioned grants. Grants are money that does not have to be paid back. Grants are given by the federal government, the state of New Jersey, for attending a New Jersey school, and also the college in the form of merit aid. Work study is working on campus. My daughter Danielle, she went to Drexel University. We filled out the FAFSA. She was granted work study simply by filling out the FAFSA. It allowed her to interview for jobs on campus. She knew she didn't want to work in the cafeteria. Too busy, wouldn't be able to study. Making minimum wage, she took a job in the computer lab, was able to study while she kind of babysat the lab. A student tried to print their paper, didn't print, she would change the paper. That would be her job, and she would make minimum wage. Make money, spending money on campus. Loans, that's also financial aid. Loans come in many forms, whether they're the federal Stafford loan, the Parent Plus loan, or outside loans. They're pretty vicious. We'll talk a little bit more about that. And scholarships, we mentioned that, and scholarships would come from many sources and certainly should be considered. So let's talk about the FAFSA. The FAFSA came live today for senior parents. If you tried to fill out the FAFSA before midnight last night, the only FAFSA you would see would be the 2020-2021. 1 minute after midnight, the 2021-22 FAFSA became available and you could start working on it. FAFSA is your website, or FAFSA.ed.gov. Don't Google FAFSA. There's too many hits of many websites who are going to want to steal your information. FAFSA.ed.gov. But before you start filling out the FAFSA, you have to go to another website, and that would be FSA ID. You can see my mouse moving. The FSA ID and password is something that is required for the student who's filling out the FAFSA and for one of the two parents. The student is going to be able to get into the FAFSA and access it using their FSA ID and password, and the parent's ID and password comes into play for what is referred to as the data retrieval tool. That connects the parent's tax return, 2019 tax return, directly to the FAFSA and populates that section of the FAFSA. So after this presentation tonight, parents and students, I would suggest you sit down in front of the computer, shoulder to shoulder. Start with a student. Go to fsaid.ed.gov. You're going to wind up with this screen. Down on the left side, it says Create an FSA ID. Click on the Create button. Start filling it out. It's going to ask for the email address. The email address is called the verified email address because only one email address can be used per ID and password. So if the student starts first by filling out his or her email address, and again, make sure that it's an email address you'll keep for the next 4 years. Student will start to enter the information after entering their email address. Username is selected. It can be, they'll tell you what the perimeters are. Password can be selected. It'll tell you how many caps, how many numerical symbols, and how many non-numerical or letters you can choose from. While you're working on filling out the ID application, the student is going to receive an email. The email is going to come to the email address that was provided in the first box. That email will have a 6-digit code number called the secure code. That secure code must be entered into this application, and it times out after about 10 minutes. So while the student is working their way through the application, providing their name, their address, their telephone number, social security number, date of birth, and so on and so forth, they're going to enter the 6-digit secure code they received by email. Select an ID, select a password, and they're pretty much done. Student takes off, mom or dad, whichever one is getting the ID and password, then enters his or her verified email address. Cannot be the same as the student. Then they work their way through the application, and somewhere in the middle of the application, they'll receive an email with a secure code. Once you're finished with that, and it'll only take you a few minutes, you then may begin working on the FAFSA. And the FAFSA is something that the student will fill out. The FAFSA is based on the student's ID and the student's password. And not till you get the section where it says, did you file a 2019 income tax return? They're talking to the parents. The drop-down will say, again, already completed, will file, or not required to file. If you click already completed, it'll ask you, do you want to connect with the data retrieval tool directly with the IRS? You hit yes. And then the parent is prompted to enter the ID and password that they've selected.
All right, we did have a question from earlier on.
Okay.
When you state talk to the financial aid office once accepted, does this only relate to college aid, or are they connected to the federal aid as well?
It's connected to both. The reason I say it's connected to both is even though federal financial aid is distributed from the federal government, it is the college's financial aid office that is, I'm going to say, the gatekeeper. Now, it's going to be based on what is referred to as the EFC, which is a product of filling out the FAFSA, expected family contribution. I'll talk about that on the next screen. The expected family contribution, after you enter the income, savings and investments for the parent, the income, the savings and investments for the student, a number is given at the end. That EFC, that expected family contribution, determines how much federal financial aid will be granted. And what I'll tell you right now, just in advance, you're not going to get much. Federal financial aid comes in the form of a Pell Grant, money that does not have to be paid back. In order to receive a full Pell Grant, your adjusted gross income has to be below the $30,000 number. Above the $30,000 number, you're not going to receive a Pell Grant. You will be offered federal loans, and there's a limit to how much they're going to give you. Even though those loans are monies given by the federal government, it is the college that distributes those loans. Every college is given a certain budget, and first come, first serve, those loans are distributed. Same thing with the Pell Grant, as I said, few and far between. The college's financial aid office also makes a decision on how much merit money, how much of the endowment, the college's own deep pockets, will help out with the cost of paying for that student to attend.
All right, we did have, there's two more questions. How does the FAFSA work if one kid is already in college?
Excellent question, and I'll hit that on the next slide.
All right, then I know there was another question about the thoughts of class of 2022 being test optional as well. I think right now, given the circumstances, they probably won't share their decision just because there's so much uncertainty moving forward. So I think right now we are on October 29th, we'll be offering the PSATs to all juniors, which is an excellent opportunity to, one, take the assessment, see how they do. There is national merit scholarship opportunities for the juniors. We're also going to be doing the PSATs for the sophomores in January. So we are still trying to get opportunities for our students to be able to take these assessments in case that schools are still requiring the tests. But I think it's going to probably be a little bit of a wait and see. So I think every opportunity we have, we'll take it as is. And I'm sure as time moves on and progresses, schools will start to share more information as they have a better idea of what circumstances will look like beginning September of 21 and obviously September of 22 as well. All right.
Good. So many senior parents and students have already gotten their FSA ID and passwords, and they're ready to move on to the FAFSA. Again, the website fafsa.ed.gov or fafsa.gov. Either one will take you there. You'll find this screen. You'll click on the button that says Start Here. Once you click Start Here, you're going to be asked, are you the student or are you the parent? Whether mom and dad are filling out this application or whether it's a student, I always suggest just click I am the student. It's going to take you to the next screen. It's going to be pre-filled with name, address, social security number, only displaying the last 4 digits, date of birth, and so on and so forth. Because you've already completed the FSA ID and you signed in as that individual, you'll work your way through the application. And again, it is given, the questions are asked from the point of view of the student, unless it says specifically parent. The parent section will include the parent's tax return, whether it's 1 or 2 parents, parent number 1, first name, last name, social security number, date of birth, and so on and so forth. You'll continue to work your way through. It could potentially take you 15, 20 minutes to fill out the FAFSA. But being new to many of you, it may take you longer. And as you turn from page to page, it will save your work. So you can leave, let the screen time out, come back at any time and pick up right where you left off. There's 5 or 7 pages that you have to work your way through. Complete the page, and the information that you've completed on that page will be saved. If there's a line that's been or left blank or not complete, you won't be able to advance to the next screen, and if you leave, you'll lose everything on that one page. Not a big deal. Once you submit the FAFSA, and you'll submit it through your electronic signatures. Your electronic signature is your ID and password. Remember, the student signed in with his or her ID and password, and the parent entered their ID and password for the data retrieval tool. So their electronic signature is already in the application. At the end of the application, you'll submit the FAFSA, and you will get a submission page. I'm one page early. Okay, you'll get a submission page successfully submitted. What you'll see on there, unfortunately, I don't show that slide right now. I thought maybe it was here. It'll say FAFSA successfully submitted. If there is a state of New Jersey school amongst the 10 schools that you're allowed to list in that FAFSA, if there's a New Jersey school on that successfully submitted page, that confirmation page, you'll be able to click on an orange tab. It's kind of like a digitized arrow, and it'll say begin your state financial aid application. Obviously, we live in the state of New Jersey, so if there is a New Jersey school amongst the 10 schools that you can put on this FAFSA, you want to click on that arrow, that orange digitized arrow, and answer 6 questions. The 6 questions. Did you receive untaxed Social Security income? No. Did you receive untaxed, I don't know, military income? No. One more question for the parent, and then the same 3 questions for the son or daughter. No, 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 and that's all you need to do for the state of New Jersey application. State grants can be substantial. A tuition aid grant in the state of New Jersey for a family that shows need can be as much as $12,000, $13,000 a year at some of these schools. After you submit the FAFSA, a day or 2 later, the student will receive an email, not the parent. So parent, you have to stay in touch with your son or daughter to find out when that email arrives. It'll say that the FAFSA was processed successfully and the student aid form is now available to be viewed. Student aid form, or SAR, once you click on that link, will open up and it will say process successfully. It'll give you the dates that it was processed. There's a couple of hyperlinks here. The first one is view or print your student aid report. That'll give you a summary of everything that you filled out, line by line. On the left are the questions, on the right are the answers. More importantly, at the top of the form is the expected family contribution, the EFC. And the EFC is what the federal government believes you should be able to afford to pay for 1 year of college for 1 student. Question was asked earlier, what if you got 2 students in college at the same time? Well, consider for a moment, the information you're getting is predominantly from the parent. What was the parent's income? What is the parent's savings and investments? How many kids in the family? How many will be attending college? In this case, it looks like the EFC, the expected family contribution, is about 20,000 plus with 1 student in college. If there are 2 students in college, you're going to fill out 2 FAFSAs, 1 for each student, and the EFC is going to be cut in half. So instead of $21,000 to send 1 in college, it's going to cost $10,000 and change to send each student because 2 FAFSAs are being filed, and you've indicated on the FAFSA that there are 2 attending college. Hopefully that answers that question from earlier.
And then we had we have 1 child in college, graduate college. The school told them not to fill out the FAFSA alone. If they make a mistake, potentially not be able to get aid. Is that true?
Yes, it is. And there are many mistakes that can be made on the FAFSA, and I'll get into that in a second or two. But consider for a moment, if you do fill out the FAFSA and you look at your student aid report, review it carefully, because if you see that there's a mistake, you can sign back into the FAFSA. See the second blue hyperlink? Make FAFSA corrections. You can go in and correct any errors that you've made. You edit the FAFSA. I mentioned to you that 10 colleges can be listed when you fill out the FAFSA. Some students apply to more than 10. So what you would do is you'd fill out the FAFSA. You'd wait to get that confirmation that the student aid report is available. You would then come into this page. You could view or print your student aid report, as I mentioned, or you can make FAFSA corrections. Go to the school selection page, cancel out some of the schools that you know already received the student aid report, and substitute in those empty lines the additional schools that your son or daughter has applied to. But Scott, the question that you asked as far as don't fill it out alone. No, you should really fill it out with your parents, because a lot of the information that's being provided is not necessarily information that the student is very, very familiar with. And the other important thing is to make sure that you check. But some of the things I'm going to talk about in the next couple of slides are going to be where many of the errors are going to be made. Was there another question before I move on?
Yeah, two more.
Wait, real quick, can I just interject real quick as a side note?
Yeah.
There are a lot of colleges that will sit with families and help them to fill out the FAFSA. A lot of colleges in our area, a lot of state schools, all the community colleges in our area, they will sit with families. Even if you don't plan to attend that college, if you've applied, they will sit with you and help you to fill out the FAFSA. I just wanted to put that out there because that's something that does come up when there are counselor events at campuses nearby. That's something that comes up and something that they boast about because they want people to feel confident and comfortable that someone is going to help them through this process. All right, continue.
Awesome.
Thank you.
At the same time, I do get calls where families will say, you know, my income was relatively low and I don't have a lot of savings and investments. I filled out the FAFSA early and I didn't get any financial aid. Well, I'll review those FAFSAs for them. It only takes me a few minutes to see if they've made a mistake and where the mistake was made, and to point out how they can easily correct that mistake, or to simply say, add some more schools to the equation. You didn't make any mistakes. The school just doesn't have enough money to give you any additional help.
All right. Another question was to clarify if separated, does only the custodial parent's information get entered or both?
No, and it's only the custodial parent. The one question early on in the FAFSA will say, what is the marital status of your biological parents? And it will ask married, the drop down married, separated and divorced, or widowed, whatever the case might be. If you click divorce, it will ask you for the month and the year that the divorce occurred. It will then ask you which parent are you going to provide information for, mom or dad. You make that decision and then you only provide answers for that parent. Everything else will be grayed out. Will not give you any opportunity to enter the other parent's information.
And where does the student get the login and password?
They go to the FSA ID screen,
Mm-hmm.
fsaid.eg.gov. Go to that screen, go to the create an FSA ID. You provide, starting with the student's email address. Remember, one email address per ID and password. So start with the student, start putting all the information, pick a username, pick an ID, first name, last name, social, date of birth, so on and so forth. Get the secure code via email that you provided in that first line. Complete the application, student walks away. Now it's mom or dad's turn to do the same thing using mom or dad's email address. Can't use the student, it's already been taken.
Bob, I know you're going to cover it in an upcoming slide, but there's a few questions coming in that are all focusing on the same thing. Questions about 401ks, IRAs, and 529 plans and how they would impact the EFC as considered investments. I know you're about to get into that.
Perfect. Okay, so as I mentioned earlier, the FAFSA is a very forgiving form. I say forgiving, case in point, divorced or separated parents. Parent doesn't have to be divorced, just separated, living in separate residences. They're only asking for the financial information of one parent. That's pretty forgiving. Dad can be making $500,000 a year and paying mom $60,000 a year in alimony. It's mom's alimony that comes into play, not dad's $500,000 income. That's pretty generous. The other thing that's pretty generous is they're going to ask you in the FAFSA How much are your savings and investments worth? Do not include your IRA, your 401k, your 403b, or any qualified retirement plan value. A lot of parents' worth is concentrated in their home or their retirement plans. The FAFSA does not ask about the equity of your home. It does not ask about how much you have in your IRA or 401k or 403b in the case of a teacher. Yet, parents make the mistake of including them as part of their savings, part of their assets. If you were to put that information in, you're pretty much going to eliminate the possibility of you getting financial aid. The other question that throws people is small business and farm. Now, I don't know that there are many families that own a farm in this area. But the question is, how much is your small business worth? And parents inevitably then start putting a number into that field. Well, there's a little question mark, which is kind of a help button. And if you click on that help button, it will say, do not include the value of a business that you own 50% or more of and have under 100 employees. People don't click on that information tab, and they simply enter a value of their business. Same thing for a farm, two types of farms. The farm that you live on and operate, or an investment farm. That information tab will tell you if it's an investment farm, include the value. If it's a family farm that you live on and operate, you do not include the value of that farm. Your small business, your house, your retirement accounts, don't include them. Don't make that mistake. And I've seen a lot of that happen.
All right, we have a couple more. A divorced and custodial parent, but the non-custodial parent will claim her for 2020. So what do I do in regards to the tax return?
Don't worry about that. As I said, where it all boils down to is, it doesn't matter who claims the student, the custodial parent or the estranged parent. It doesn't matter. The custodial parent can still say that the student lives with him or her, even though the other parent is taking him on a tax return. And the FAFSA doesn't ask who took that deduction, does not ask that question. And it's not on the data retrieval information that is electronically transferred to the FAFSA. So don't worry about that.
Awesome.
The important thing to consider is, will you qualify or will you eliminate yourself from getting the higher education tax credits? Because there is a phase out. And if dad makes a lot of money and is above the phase out number and is claiming the student, that $2,500 disappears. Where if he shifted the little financial planning, shifting the deduction to the custodial parent who makes less income, and that's an extra $2,500 toward college plus additional tax breaks.
Can you explain the phase out number?
Phase out number, as I recall, for a married couple is $162,000, where you get partially phased out and completely gone at $180,000. So that would be anywhere from about $80,000 a single individual on up to $90,000 for an individual for the phase out.
And does that mean you don't qualify for aid?
No, you don't qualify for a number of things. One of which is the American Opportunity Tax Credit. Another one is the Earned Income Credit. Another one is the child tax credit. You understand that the tax system understands that there's a cost to raising a family. The tax system gives breaks for people who are earning just enough money to get by. And for people who have plenty of excess money, and that's where phase out is calculated. The IRS decides that those tax breaks and credits are not needed. So, and again, I call financial aid something that comes from the federal government, the state government, and also from the college. And also, which you're not going to read anywhere, from the tax system. And that's where financial planning comes into play.
All right, two more, and then we'll move forward. I know there's a couple more on there, but I don't want to take, we'll come back to those. Does the FAFSA stay the same for each subsequent year in college? And if separated, does it need to be legally separated or just different different residences, but they filed joint taxes.
Well, and that's, okay, for starters, the FAFSA is going to be filed every single year. So senior parents, you're filling out the FAFSA October, anytime after October 1st for your son or daughter's first year of college. Come October of 2021, the FAFSA opens up again for you to complete for your son or daughter's second year of college. Now, you don't have to complete it on October 1st. It just becomes available October 1st. You should get it completed, let's say, within a reasonable amount of time, hopefully before the end of November. Get it completed for their freshman year before November 30th, 2020. For their second year, go in, work on it, and get it completed for their second year of college before November 30th, 2021, and so on for 4 years. It's going to change minimally each year because Congress ultimately changes certain laws that do affect the questions that are being asked on the FAFSA and the way that you fill out the FAFSA. So I wouldn't consider it done 1 year and finished. You got to do it every single year. The important thing is the first year, though, because I call that the freshman signing bonus year. Because that first year of college, a student might be considering 5 or 6 or 7 or 10 or 15 different schools. And these schools are in competition for that student. Once the student decides where he or she is attending, it's in all likelihood they're going to stay in that school for the next 4 years. So you're going to get the biggest bang for your buck by filling out the FAFSA for their freshman year. Second year is just going to be, let's review the information, make sure it's still the same and the need is still there. If they give you merit aid, it's going to continue for 4 years. As long as you remain a full-time student, maybe even a half-time student or more, and maintain a B average or better, then your merit aid continues. That's not a concern. What was the second part of the question, Scott?
Legally separated or just different residents, but they filed joint taxes.
Right.
Do they need to be
I got a
legally
call.
separated?
Yeah, I got a call one time from a mom who said, I'm separated and I'm filling out the FAFSA as a custodial parent. I said, okay, great. What questions do I have? Well, do I have to show a separate residence from my estranged husband? We're separated. And I said, well, does he live in the same town? And she said, he lives in the basement. We have the same address. I'm living on the top floor, he's living in the basement. That's still acceptable. But you have to be able to kind of document that there really is a separation. Anyone can call themselves separated, but you really have to be able to provide a little bit of documentation. It's going to be difficult if dad is living in the basement, mom's living upstairs, because addresses are the same. If dad were to move out, I would say get the change of address on the driver's license, on the voter registration, anything that documents the fact that he is living apart. So that's a tough call when you're that close in proximity.
And then two questions that were that came in. One specifically about second homes or investment properties,
right,
and that impact on the FAFSA. And
right,
there's a couple more questions about explaining the phase out number again. Okay.
So let's consider for a moment, your primary residence is not counted. Again, on the FAFSA, nor is your retirement accounts, I told you that, nor is your small business. Under 100 employees own 50% or more. But some people own second houses. Well, you only have one primary residence. So a second house is an investment. And it's the net equity that you have in that investment. And I'll mention another case in point, a little bit of thinking through this. Working with a family who had a house that was worth somewhere in the neighborhood of $600,000. And just through regular conversation, I understood they had a $350,000 mortgage. Part of their investments included another house that they owned up in Hunter Mountain. The house in Hunter Mountain was fully paid for. What's the value of the house? $300,000. Fully paid for. The primary residence has a $350,000 mortgage. So their net equity in the $600,000 house is $250,000. The net equity in the house in the Hunter Mountain is $300,000. I said, why did you take a mortgage on your primary residence to buy the house in Hunter Mountain? Because the banker told us we would get a better rate if we financed our primary residence. Well, fine, you just cost yourself a lot of financial aid. Suppose for a moment that they took a $250,000 mortgage on the house in Hunter Mountain and took that $250,000 and paid down a chunk of the mortgage on their primary residence. Primary residence is still invisible, whether they got $250,000 worth of equity or $450,000 worth of equity. It's the investment property, the second home, that counts. So by taking a $250,000 mortgage out on a $300,000 home, you've just reduced your investment property from a $300,000 value to $50,000. It's just a matter of logically thinking this thing through. Again, one, primary residence is invisible. Any other real estate is investment property.
And then,
Second question.
And then the second one, and we'll come back to the phase out again, but my daughter works part-time and filed her own 2019 tax return last year. So are both parents and the student tax returns retrieved from the IRS to use on the FAFSA?
Yes, they are. Both are retrieved. The student, when the student gets to the student section and the question is did you file a 2019 tax return? The drop down says already completed, will file or not required to file. If the student clicks already completed, they're going to ask, do you want to use a data retrieval tool? Click yes. Student is already signed into the FAFSA using her ID and password. So that step is eliminated. It's going to take you right to the IRS website. Once you get to the IRS website, it's going to say, what address did you provide on your 2019 tax return? It has to be exact. If I live at 123 Main Street in Hackensack, and my tax return says 123 Main ST period, Hackensack, and I write out the word street, it's going to say, sorry, no match. It's going to take you back to the FAFSA. You have to have a copy of your tax return to make sure that you fill out that section on the IRS website that accurately portrays the address listed on your tax return. You live in apartment 1B and you put on the address apartment B instead of 1B where you've listed 1B on the tax return, it's going to take you back to the FAFSA and it's going to be rejected. Have your tax return handy, parent and student.
Bob, impact of a 529 plan.
Okay, that's where I'm going to get into the expected family contribution. I'm going to break that down. If there's any more questions, I'll move forward. Okay, so expected family contribution. I'm going to talk about what it's comprised of. The expected family contribution, again, to repeat, what the federal government expects the family to be able to afford to pay for 1 year of college for one student. It is a product of the information you provide on the FAFSA. On the FAFSA, you're going to provide 4 components: parents' income, parents' savings, students' income, student savings. Let's start with the parents' income. The parents' income is measured at 22 to 47%. So let's use a real quick example. First of all, they're going to look at what is referred to as adjusted gross income. Adjusted gross income is line 7A. I don't know, can you read that? 7A. Hold on one second. 2019 tax return, or is it 7B? The adjusted, I can't read it. I got a little bit of, I got part of the screen covered up because I got you guys on here. So the number on 7B is $100,000. That 7B number is the adjusted gross income. And it is a product of what you made in W-2 wages, interest income, there's nothing here. Dividend income, there's nothing here. IRA distributions, and anything else that comes into play like Social Security benefits. So in the case of adjusted gross income being $100,000, 47% of that is $47,000. You hit the 47% number when your adjusted gross income exceeds 70 grand. It starts off at 22% at $30,000. So if your adjusted gross income is $30,000, that's line 7B on the 1040, you're expected to be able to afford 22% of that $30,000 to pay for one student for 1 year of college. But let's assume for a moment that we work with this 70,000 and above. At 70,000 and above, you're at the 47% number. And I'm sure a lot of you folks out there are thinking, well, gee, how am I supposed to afford college if the EFC, if the expected family contribution quickly rises to $47,000 at $100,000 worth of adjusted gross? Well, they look at the family size. Family of 4, mom, dad, son, and daughter. Hypothetical question, because I know I can't get an answer. How much does it cost to raise a family of 4 for 1 year living in northern New Jersey? According to the Department of Education, $28,000. So they're going to give you a break. They're going to say your adjusted gross is $100,000. We're going to knock off $28,000 because you're a family of 4. So we're going to calculate 47% of $72,000, roughly 33 grand. You're still pretty exorbitant. Rutgers University is $25,000, $26,000, $27,000 a year to attend. Rider University might be $57,000. But the fact of the matter is you're already expected to be able to afford $33,000 and they haven't looked at your savings or investments yet. For every additional person living in your house, they're going to give you another $4,000 or $5,000 above and beyond that $28,000. Even if it's your mother-in-law or father-in-law who's living with you, that's another mouth in the house, mouth to feed. So at 22 to 47%, that's component 1 of the expected family contribution for the parent. Then they look at the savings and investments. Remember, the savings and investments do not include IRAs, 401ks, 403bs, any other qualified plan, including an annuity investment. Don't rush out and buy an annuity, though. It's not going to help you, and I'll explain why. The savings and investments, other than those that are eliminated, are measured at 5.64%, a lot less than 47%. So if you had $100,000 in savings and investments, 5.64% of that is $5,640, added to the $33,000 that income just put you in if you had $100,000 in a family of 4. So now you're starting to build this up. Then they look at the student. And they say the student can earn $6,000 without being counted, and everything above $6,000 is going to be measured at 50 cents on the dollar. So if they earn $7,000, it's another $500 you're adding to the EFC. If the son or daughter has money in their name, 20% of the value of their investments, not 5.64% that the parents was measured at. The 529 plan is counted as a parent asset, 5.64. But there's a break for the parent. They look at the age of the older of the two parents. And just for a starting point, a parent who is 50 years old can expect the first $50,000 of their savings and investments not to be counted. So outside of your primary residence, your IRA, your 401k, your 403b, and your small business or farm, you have $100,000 in savings and investments. Dad is 50 years old. Instead of 5.64, $5,640, they're going to say 50,000. Dad is 50, the first 50 doesn't count. They're going to cut that 5,640 in half, and you're paying about $2,300 in expected family contribution. So 529 parent asset. I think that was the question. Hopefully that was the long answer. Not too long. Parents might be asking, what's the point of me filing a FAFSA when it looks like I'm not going to receive any aid? And again, you're not going to get any federal financial aid unless your adjusted gross income is down around the $30,000 number. And even at that, a Pell Grant is only about $6,300. Rutgers cost about $2,600 or $26,000. How big of a dent is $6,300 going to make? You filled out the FAFSA, you're going to qualify for $5,500 worth of federal student loans. The good news is $3,500 of that is interest-free, payment-free. Free money. Parents say, well, gee, I don't want to borrow money. Well, If someone said to me, Bob, would you like me to loan you money? I'd say, what's the interest rate? If they said 0, I'd say, give me $20 billion. Because I would take that money interest or cost free and I'd invest it at 0.25%. I'd be a millionaire. The idea is the federal government on the $3,500 Stafford loan is giving you free money and it's not accruing any interest or requiring any payment till 6 months after the student graduates. Right off the bat, there's an opportunity to fill out the FAFSA. Second year student, instead of $3,500, they get $4,500. Third year student and fourth year students, $5,500 each year. There's also an unsubsidized portion each year for $2,000 at a really small rate of interest. When we reach this stage in life and we're raising our kids, they're ready to go to college, we can use every dime we can get our hands on. Filling out the FAFSA is at least going to get you there. So you know what the adjusted gross income is? And consider for a moment that when you look at the tax return, you're looking at the front page of the tax return, line 7B, doesn't take into consideration what you paid in mortgage interest or taxes. In 2018, they changed the law and they gave everybody the standard deduction. If you can claim itemized deductions that exceed $24,000 for a married couple, you can reduce your taxable income by more than the $24,000 in standard deduction. But your adjusted gross still remains the same. So what they're thinking about, what they're calculating for you to be able to afford college is not based on what you've deducted for taxes or mortgage interest. It's based on your gross, your adjusted gross income, AGI. So let's figure for a moment. What are you paying property taxes? $8,000, $10,000, $12,000, $15,000? If you lived in Iowa or Kansas, your property taxes might be $750. How big a mortgage you have? $250,000, $350,000? What's your mortgage interest? $8,000, $10,000, $19,000? If you lived in Kansas, you probably only had a $75,000 mortgage, and you may have paid somewhere in the neighborhood of $3,000 in mortgage interest, if that, probably a lot less. Yet you earn $100,000 just a gross income living in Kansas versus $100,000 in northern New Jersey. It's a lot tougher to make ends meet here, but in the eyes of the Department of Education, you're all on the same plane. So I told you about EFC. Expected family contribution, it's only a number. It's a product of the information you provided in your FAFSA. And it tells you what the federal government expects you to pay for 1 year for one student to attend. Well, what do you do with that number? College doesn't have to give it to you. College doesn't have any money, especially the state schools, to distribute. And they can only distribute federal money to a limited extent for someone who has a very low income. So your EFC, what do you do with it? Well, let's look at the next component, the cost of attendance. Every school publishes what it costs to attend their school. And that's all in. That's tuition and fees, room and board, books, supplies, computer, transportation, personal expenses. When my daughter Danielle went to Drexel University, she had a meal plan. That was part of the cost of attendance. But sometimes she liked to go to Starbucks with her friends. That is personal expenses. Drexel is in Philadelphia. It cost us to get her down there. She wanted to come home for the weekend. Cost us some money to get back home again, back to school again, transportation. Every school is going to publish the cost of attendance. So when I tell you Rider University costs $57,000 a year to attend, that's all in. And they're figuring a certain amount of money toward books. Well, if they figure $1,200 a year toward books and you only spend $800, you're ahead of the game. But they gave you a number, the cost of attendance, to figure from. So you take the cost of attendance and you subtract the expected family contribution. And that shows need. So this is kind of a little test, not a test, but a review of what we talked about. In this example, we have an EFC, expected family contribution, $25,000. Custodial household is made up of a family of 4, 1 student attending college. Custodial parents are married. Both are age 50. What have you learned so far? At the age of 50, you know that the first $50,000 in savings doesn't count. Every year over 50, you add another $1,100, $1,200 toward that. 51-year-old parent, 51,400 ballpark. Doesn't count. 60-year-old parent, you're talking somewhere in the neighborhood of 57, 58,000, and savings and investments don't count. So again, family of four, one attending college, custodial parents are married, both age 50, adjusted gross income of 100,000. Family of four, 28,000 comes off the top, right? Savings and investments, $50,000. Students' income, 3,000 below the $6,000 number and has no savings. What does it all mean? It gives you a number called financial need, cost of attendance minus expected family contribution. How are you gonna make up that need? You know what it costs. You know what the Department of Education expects you to pay. The difference is need. It's not only the need that you got to come up with, but what the college or other grants and financial aid doesn't deliver to you. So let's use this slide. Community college, cost of attendance, $5,000. Remember, this family has an expected family contribution of 25 grand. So they're expected to be able to afford to pay 25 grand. Their need is zero. State school, $26,000. Their expected family contribution, 25 grand. Their need is 1,000. Private college, 50,000. Their need is 25,000. Elite, 60,000. 25,000 expected. Their need is 35,000. How are they going to pay that need? No one is going to promise you that. So let's figure. Let's look at it from the point of view on how a college thinks. Let's look at a private school, $50,000. School, private college, is getting an average incoming student of 3.0 grade point average. Where the elite, Harvard, Yale, Princeton, Duke, Emory, is getting a 4.0 grade point average student every time. They're turning away students who apply that have 4.0 grade point averages. They have more than they need. Private college can charge $50,000 because they're not an elite. They're businesses. They want to be able to charge as much as they can get. But they can only attract students with a 3.2, 3.3, 3.4. They'd love to get a 4.0 student. 4.0 student comes along. Private college says, this is a kid that we want. We're going to accept this kid, and we're going to start making it affordable. We're going to start piling on free money. Why? We get this kid to attend with a 4.0, he or she is going to raise the average of our incoming student. The closer we get to that 4.0, the more likely we're going to jump to class, and we're going to be an elite college. If we become an elite college, we're going to have 4.0 applicants all the time, and we're going to be able to charge a lot more than we're charging right now. Think of the state school. I say state school, but let's just say a less expensive school, for lack of a better term. They're attracting students with an average of 2.5 grade point average. Kid with the 3.0 applies. This school is thinking, wow, we accept this kid with the 3.0, raises our grade point average from 2.5. We can soon start charging closer to 50 grand. We're only charging 26 grand. The logic is that the colleges are competing for the bright students. So when I say there are 3 levels of school, safety schools. Safety schools are the schools your kids are going to get into based on their grade point average and their SAT score. They're going to get in, safety school. Target schools, right where your GPA and SAT scores are. You're going to apply to the target schools, but you're also going to apply to the reach schools. And those reach schools are the schools that if you get into, you're not going to get much of any financial aid because you're nothing special in their eyes. You have not a lot to offer. You're not going to contribute to the increased average of their GPA. But you're going to get into that school, you're going to wear the sweatshirt and brag that this is the school I'm going to, the second half of your senior year in high school. But your parents are going to pay. So what I would suggest to you, as you work with the guidance department, the guidance department is going to tell you what your safety schools are, what your target schools are, and what your reach schools are. And apply a fair share to each, because you want to be able to compare the cost, the net cost, when it's time to decide what school you're going to attend. And if you have enough of a selection, part of your other argument, rather than just claiming a hardship, is you can talk to the colleges that you've been accepted at and say, well, gee, you know, I can come to your school at $50,000. You've accepted me and you want me to come. I'm paraphrasing here. but look, I can go to this other school for $35,000. And they might say, show us the offer letter. And they might bring the cost down and they might meet it. The idea is you got to get the schools to compete. Should I move on or are there questions?
Move on.
So we know who's eligible. You have to be a U.S. citizen or permanent resident. You don't have to have a social security number. You can fill out the FAFSA with all zeros if you don't have a social security number. We're looking for a high school graduate or GED. Male applicants at the age of 18 have to register for the selective service. One of the questions on the FAFSA is, have you registered for the selective service, the draft? You put no. They're going to say, would you like us to register? You put yes. If you put no, you're done. You can't go any further because you're not going to get any financial aid. It's the law that you register, and it's a quick way, an easy step to get registered just by filling out the FAFSA. We know where the money comes from, free money, loans, and employment through work study, private scholarships. Okay, so the Pell Grant. I have 2021. I think it's the same number for 21, 22. $6,345. Your adjusted gross has to be below the $30,000 number. Even at 30, you're not going to get the full $6,345. SCOG grant, $4,000. Teach grant, if your son or daughter wants to become a teacher, they can award up to $4,000 for the teach grant, but there's a cost, so the net amount is going to be $3,728. And you have to give back, if you're awarded that grant, by teaching in, let's say, in a neighborhood that is not, let's say, urban neighborhood, let's call it, okay? So you got to give back in order to get that teach grant. Work study, again, you'll get minimum wage, and they'll tell you in the award letter how much you can qualify, how much you can earn. It's not going to count against you. It's not going to count toward the $6,000 a student can earn for the FAFSA. I talked about the subsidized loan for freshmen, $3,500, $4,500 for sophomore, $5,500 for junior, senior, and the unsubsidized $2,000 each year. Each of my kids graduated with $27,000 worth of federal loans. That would be $3,500 plus 2 for the first year, $4,500 plus 2 for the second year, $5,500 plus 2 for their junior, and $5,500 plus 2 for their seniors. $27,000 if they graduate in 4 years. Not everybody graduates in 4 years. 6 months after graduation, you start making payments toward those loans. If the parent can afford to, they pay off those loans and say, congratulations, here's your gift for graduating. It's an incentive to complete school in 4 years. My daughter Danielle graduated with $27,000, got a job right off the bat, started paying her student loan, developed a great credit score, decided she was going to buy a row house in Philadelphia. It's about 25 feet wide, but it's her own house. She bought it on her own because she had a great credit score from paying her student loans. This slide shows you why I hate loans. Parent plus loan. Parent borrows the money, it's not the student. Parent borrows the money, they pay an origination fee of almost 5%. Right off the bat, 5% out the window. 10 to 25 year fixed rate loan, 5.3%. You can borrow money against your house right now for about 2.25, 2.5. I talked to a lot of parents about taking out home equity loans on their home and possibly getting a tax deduction on it rather than paying 5.3% plus 5 points to get a Parent Plus loan. New Jersey class loan, 10-year payback, APR 4.45 plus 3% upfront origination fee. They stink. They're terrible. This is what the federal government should be working on. Bring down the cost of student loans. It's highway robbery. It really bothers me. Okay. Any other questions coming up, Scott?
We have one, and it's won't financial aid landscape change dramatically due to COVID?
Several things are occurring with COVID, part of which is the colleges are making a lot less money. I think they're Their revenue is down on average about 22%. It's down 22% for a number of reasons. They can't charge full boat for virtual classes. In addition, they're getting a little bit less students attending. The cost of going to college is coming down. In addition, the colleges are having to dig a little deeper into their pockets to help families who've been affected by the shutdown. And there's a lot. That makes less money available in the form of merit aid. But again, if your son or daughter is an exceptional student, not exceptional just in general, but I'm saying exceptional as compared with the college they're applying to. So rather than apply to Princeton, Harvard, Yale, Duke, Emory, schools like that, apply to a school like Rider University. It's a great school. It's only about an hour and a half south of here. Rider University has the presidential scholarship. Rider University is kind of saying, please apply to our school. And if your grade point average is 3.2 or better, you can earn the presidential scholarship. Though it's a $57,000 a year school, they'll give you $24,000 off the cost if you apply. And I say if you apply, you get accepted. You got a 3.2 grade point average or higher, $24,000 off the cost to Rider University. Why Rider University wants to increase its average grade point average incoming freshman class. A lot of schools will post this on their website. And again, if you go to collegeboard.org, go to the search button, type in the college name. I think this section is called Big Futures. It talks about what kind of financial aid is offered and what the grade point average is of the incoming freshman class from the last few years. Some people use collegeboard.org as a way to research and build their college list. You can also get that help from the guidance department. They're going to be able to tell you which schools are the best fit. They're going to tell you what your safety schools are, your target schools and your reach schools are. And I urge parents not to succumb to the school with the biggest name. Now, it would be difficult for me to tell my son or daughter, you can't go to Harvard or Princeton if they get in. I would do everything in my power to make that work. But when you're talking schools that aren't going to matter, if you got an exceptionally bright student, they're not going to stay in school for 4 years. They're going to go beyond those 4 years and get a graduate degree or professional degree. The idea is college will be the stepping stone. And you have to manage your resources. At our age, we know we have to be able to retire. And I see folks day and night who don't have enough retirement savings and are going to be working well into their 70s. I don't want to see that happen to you. There are tools, there are strategies, there are approaches to take where you can get a good part of the cost of college paid for. And rather than letting this 16, 17, and 18-year-old son or daughter dictate what your retirement plans are going to result in, you have to take charge. You have to apply to safety, target, and reach schools, compare prices, work with the financial aid office, get the cost down as much as you possibly can, and build your retirement resources, especially if you're a small business. Small business, we can work miracles for, as far as moving money from the income side of the tax return to the retirement side. And that's where you can effectuate a change. Now, with prior, you're using tax returns that were finished in 2019. Too late for senior parents. Too late pretty much for junior parents too. But freshman and sophomore parents, if you're a small business, it's worth really building a strategy and some thought. So if you're a senior parent, you haven't yet completed your ID and password, remember, fsaid.ed.gov, you need an ID and password for the student using his or her email address. Then you go back in as the parent using your email address and get one for yourself. Once you get the ID and password, you go into the FAFSA, you sign in as a student. And you receive the secure code. So the free application for federal student aid, we're getting close to the finish here.
I was going to say, yeah, we have about, we're at about an hour and a half. So I think I think we have 2 more questions, and then we could, wrap after that.
Okay, then I'll talk faster. What are the questions?
The one that just came in is, what are we listing on the FAFSA if we are not including our 401ks, IRAs, small business, our primary residence in terms of assets being considered on the FAFSA, as in bank accounts, student bank accounts, etc.? What kind of investments should we definitely list?
Okay, so the FAFSA is actually going to break it down. It's going to say how much you have in checking and savings. This is a number you're supposed to be honest about, and you understand there's no way they'll ever ask you for bank statements. The data retrieval tool will show how much you earn in interest and dividend income. So if you have interest income of $6,000 or $7,000 and say you only have $20,000 in savings and investments, that's going to raise a red flag. Interest rates cannot generate that kind of money on $20,000 worth of savings and investments. So the only way that they're going to know that you're reporting an accurate number is what is reflected on your tax return. Interest income, dividend income is a sure giveaway. When you have savings and checking, those numbers change daily based on paying your mortgages, paying just regular living expenses. So if you have $10,000 in checking account and you put down $2,000, I'm saying it's a moving number. You're not really set on, I have 10,000 in checking and it's going to be 10,000 tomorrow, it's going to be 10,000 next week and 10,000 at the end of the month. Not the case. When it comes to investments, investments are mutual funds, stocks, bonds, second houses, that sort of thing. Net equity in the house, the second house. It's not going to ask you about your primary residence. That question's not there. The investment section is how much you have in cash, savings and checking, and how much you have investments. Do not put 401k IRA.
And then we have another one. How does 529 count as income? And should we make a large deposit for 529 before college?
Right. 529 does not count as income. There's no deduction on your tax return to put money into a 529. None. So if you make $100,000 and put $20,000 into 529, your adjusted gross is still $100,000. Putting money into a 529 does one thing. It allows it to grow tax-free if you use the money to pay for qualified higher education expenses. If you take money out of that 529 for anything that's not considered a qualified higher education expense, it's going to be a taxable event. When you take money out of a 529, you'll receive a 1099-Q, distribution qualified for higher education. When you pay a tuition, you're going to receive from the college a 1098-T. Both of them are tax reporting forms. Both of them go to your accountant. Your accountant plugs it into the worksheet on publication 970. It all works within his or her computer software. And it spits out the result, and it makes a determination whether the money you took out of your 529 is taxable or tax-free. Don't overspend. Accountants really just plug the numbers in and don't necessarily give you the counseling on what's a qualified expense and what's not. Room and board are not qualified. Tuition, books, computers are. Parent pays $50,000 to send their kid to school, of which $15,000 is room and board. They take $50,000 out of their 529. That money they paid for room and board is taxable based on the calculation. Don't put money into your 529, in my opinion, if you have a son or daughter who is in 8th grade or older. 529, in my opinion, should have been funded when they were young. It gives the money time to grow. At this point in your life, if you buy a 529 from a bank or a brokerage firm, I can sell you a 529. I would get a commission if I sold you a 529, but you need that money to pay for school. You don't need to pay me a commission to put money aside to be starting off in a hole if you're saving money for college. Don't fund your 529 unless your son or daughter is very young.
And then probably the last question, if you could just clarify just one more time, there was another question about the phase out number. And then we'll conclude. And just for everybody else, if there's any other questions, we're going to make the recording available. We're going to make the presentation available. You see Bob's email at the bottom. You can reach out to Bob, myself, or Mr. Paul with any of your questions. But we'll finish with this. And if anybody else has an additional question off to the side, we'll add it to the chat, but we'll try to wrap with this one. But we'll let Bob finish, and then we'll sort of close it out.
So there are a number of higher education tax benefits. The best of the three would be the American Opportunity Tax Credit, $2,500 a year if you pay higher education expenses. That $2,500, even if you don't pay taxes, a tax credit is money given back to you, even though it's not money you've ever paid in. So if you make, I'll make up a crazy scenario. If you make $30,000 a year, and you took the standard deduction of $24,000, you have now $6,000 in taxable income. For each dependent student, you're going to get another $3,400 in exemption. In essence, you're not going to pay any taxes. But if you paid higher education expenses and qualify for the $2,500 American Opportunity Tax Credit, even though you paid no taxes, you're getting a check for $2,500 as a tax refund. That $2,500 or American Opportunity Tax Credit, higher education tax credits and benefits and deductions are eliminated if your adjusted gross income is $162,000, married couple. It starts to get eliminated at 162 and it's completely gone at 182. So the point being, if dad is earning excessive amounts of money, $250,000 a year, he is phased out. He does not qualify for the higher education tax credits and deductions. If he claims the son or the daughter on his tax return as a dependent, he will not get the $2,500. If he lets mom take the deduction, mom will wind up with the $2,500 if she's below the phase out number. So it really warrants, it's not so cut and dry. It really warrants some conversation. And that conversation is something I'd be happy to help you with if you're kind of on the crust. But the idea is, it's got to be an agreement between mom and dad. It can be a touchy subject because a divorce agreement, settlement agreement, clearly spells out who gets to take which child as a dependent in which year. When you start treading on that territory, if there's not a complete understanding by both parents, they don't want to go there. $2,500 is not going to make or break the cost of attending college, but every little bit helps.
All right. Well, at this point, I think I do want to thank Bob for all the information he provided. I think it was, hopefully it was beneficial and useful. Thank everybody for attending. I mean, we had over 60 parents and guardians, and it seems like some students too, which is an awesome event too. So hopefully we answered all your questions. We are going to be sharing out some more information. We're going to be sharing out the video. We're going to be sharing out the slides. I'll email everything home exactly through Blackboard the same way that you got the invitation for these links.
Scott, I'd like to make one final point, if you don't mind, only because we're on that slide.
Yeah, go for it.
All throughout the conversation, I talked about the FAFSA, Free Application for Federal Student Aid. About 10% of the colleges ask for an additional form called the CSS profile. That picture that's displayed on the screen right now. The CSS profile is the institutional form. The difference between the FAFSA and the CSS profile. FAFSA only looks at the custodial parent. CSS profile asks for both parents' information. FAFSA does not look at the primary resident. CSS profile wants to know what the house is valued at. FAFSA does not look at the retirement accounts. CSS profile asks what you have in your retirement and how much you're putting in every single year. FAFSA doesn't ask about your small business or farm. CSS profile wants to know about both. It doesn't mean you'll get less college financial aid from the CSS profile. These are colleges typically with deeper pockets, and there are different strategies for dealing with that. It's only 10% of the colleges, but if your son or daughter applies to 8 to 10 schools, inevitably 1 or 2 of them is going to be a profile school. Call me, text me, email me. I'm happy to answer questions, folks.
Awesome. Thank you so much, everyone.
Excellent. Thanks, Bob.
Yeah, thank you, and enjoy.
Aspetta, viste?